As that happens, Jim Iuorio is with us. He's managing director at TJM Institutional Services. Jim, what happens if we go to zero or invert here?
Well, remember, in the past, it's been 14 to 18 months after the inversion of 2s to 10 that the recession starts. And yes, it has been a pretty good predictor in the past. My contention has been over the last couple of years that with all the central bank involvement that we've seen, that's distorted the long end rates across the world. I mean, 15 trillion of sovereign debt is trading negative right now, including 50-year bonds out of Switzerland. To me, it seems like that's distorted a little bit. So I question the predictive power a little bit. I'm not saying it's nothing. I'm saying I don't think if it's a huge deal, one, as it used to be, and two, the recession could be for a long time. So, I mean, as far as the time to panic, it doesn't seem like today is it.
So if you think that central banks have sort of distorted the action in the bond market, then do you think that the 10-year, whenever we drop, do you think that the markets are going lower for no good reason?
I'm not even 100% convinced, by the way, that stocks are getting hit because everybody's flocking into the 10-year. I think it starts that way a little bit, and then both things kind of feed off themselves. As soon as the stock starts a gap lower, that accelerates that move into the bonds. But I think that's it, not for no good reason. Market position is a strange thing, and every once in a while, we have to get slapped in the face to remember what risk is. There are real risks. Last year, we realized that, perhaps China's not very willing to negotiate right now, and they want to wait till after the election. Two, we've seen, mobilization in Hong Kong that's scary. We've seen Argentina, and granted, an Argentinian currency crisis happens about once every 2 years,
right.
So it's not a huge thing, but there are things to worry about.